Hello, good afternoon, boa tarde, todo mundo. Easy. My name is Thomas. I'm from Nubank. Nubank is Latin America's largest financial institution, and it's still awesome for us to be on a global stage like this. Sao Paulo has a really big FinOps community, really well connected. You've heard some of them over there. But still on a global stage, Brazilian companies are still not represented at all times. So for us, it's really nice to get all this attention and the opportunity to share some of the success stories that we've had over the past few years. All right, Brazil is an awesome country. It's very beautiful, beaches, carnival, animals, waterfalls. I mean, anything you can imagine, deserts. But unfortunately, we also have a lot of poverty and a lot of inequality. Half of the population lives at or below the poverty line. And for decades, that meant being excluded from any financial services. No bank account, no credit card, certainly no loan product, and not even a place to store your money because traditional banks just didn't believe that these customers would have any value. So that's where Nubank stepped in. We made it our mission to fight complexity, paperwork, all these inexplicable fees, and to also offer financial inclusion for all parts of society, even if that means just having a small bank account, a small credit card, an acai stand, and a dream. And that mission, it worked. We are now serving 115 million customers in 3 geographies, Brazil, and then our newest market, Mexico and Colombia. We're a born-in-the-cloud startup that creates safe, simple, and 100% digital solutions for clients to take control of their own money, literally in their own hands. And when I say steep growth trajectory, look at where we started 7 years ago and where we got to today. It's 140 million. It's from last year, 115 million customers. That's a big number. That would make us the second largest retail bank in the United States. Not that we're counting, we are. But it's something that we're very proud of, and every second adult in Brazil has a little Roxinho credit card in their wallet, so that's always something that makes us very proud. But when you grow that fast, your cloud cost is also growing fast. We added a bunch of new products, and our AWS cost skyrocketed. Now, growing AWS cost or growing cloud cost isn't necessarily a bad thing. I think no one will argue that $1 additional of spend, that unlocks $10 of revenue. What's important is that the company growth outscales the cost growth, and that growth happens efficiently. And that in turn also from management to be able to take decisions of new market entry, new product strategy, etc. We need to be able to forecast those costs. Otherwise, we will constantly have to reprioritize, chase our tail, and not be able to make good decisions. And also remember that when you're serving a very large customer base that has a very small income, every real matters not only to the customers, but also to your bank. So you can't afford inefficiencies, and you also can't afford inefficiencies in forecasting. But unfortunately, when we started this whole forecasting process, I mean, look at this gray curve. This isn't the heart rate of someone at day 5 of Carnival. This is how bad we actually were in forecasting our cloud cost for years, and completely detaching from a growing banking reality. I mean, at one point, we had 75% budget deviation. 75%. Yeah, exactly. That's how people were looking at us when we went into these monthly reporting meetings and said, hey, no, we're 75% above budget. It takes away trust, and it also takes away trust in the whole FinOps practice in a bank. So we weren't really forecasting. We were wishful thinking every 12 months again and again. I mean, we usually budget in September. And then by the time the new year rolled around, we were already in the red again. The year hadn't even started. And I mean, you can have crashes. You can have new rates negotiated with your vendor. You can have unforeseen regulatory or security or functional requirements that can blow out a budget easily. But I mean, look at this curve. It was systematic. We sucked. So we had to fix it. And so at first, we did what every self-respecting tech company would do. We built a model. We started with one model for the entire company. And by we, I mean the FinOps practice was projecting the budget for the entire company with little connection to the business. Autoregressive, and that itself is already problematic when you have hypergrowth, because autoregression takes into consideration past historic trends, but when your growth is faster than your growth history, you will get away from the two curves. And we did. I mean, it's totally unpredictable. We went up, we went down. So after 2 years, we decided to drill it down into two budget components, our two main components. One is what we call our microservices, and one is our data, our batch processing environment. And those costs we allocated across 8 BUs. Still auto-regression, we made some manual adjustments, we segregated into our main AWS services, but we got even worse. This is the year that took us to 75%. So we had to change tactics again, and we did. We started to get more granular. It was the first big step for us that we created 45 budgets, one for each BU. Doesn't matter if you're vertical, if you're horizontal, you get your own AWS budget. Still owned by the FinOps team, so you have the same problem that you had all the time, that you're not considering the business in your AWS forecast. And the result, I mean, we went from being really terrible to mid-level terrible. So we had to do one more thing. We introduced demand drivers, again, for all the 45 BUs. And demand drivers are proxies for the business activity for your respective BU. So it could be transactions, it could be active customers, it could be security incidents, it could be fraud messages, it could be anything that is actually already being owned and forecasted by the business. So that has a sweet side effect. It turns around the entire responsibility, takes the forecast out of the hands of the FinOps team and puts it into the lab of the business. And therefore makes the business owner of their own budget. So that's great. Now teams can create their own budget. They can't point fingers at the FinOps team anymore. And everyone should be happy, but yeah, we still were mid-level terrible. So then what we did is we went one step further and we went even more granular. We encouraged business units, 45 of them, to create their own budgets using small segments, drilling down into their costs, creating what we call buckets, increasing the granularity. We had some BUs went up to 26 buckets. That's 26 mini budgets within a budget. And yes, that increases effort. And yes, there was some complaining. But in the end, we really managed to get from 75% budget deviation to less than 1% on the year to go. So that's a really awesome achievement. It helped us to solidify our FinOps culture. It helped us to gain trust across the whole organization. And it helped management and the product teams to make better decisions, more informed decisions, and really trust into the numbers and their forecast, and make cost efficiency a requirement in the product decision making. So now I've identified the two game changers, right? Granularity and demand driver, but it's probably still a little bit vague for you, so I will go into detail on both of them. First, let's talk about granularity. Granularity is drilling down into buckets and identifying different cost groups that behave differently. I will show you exactly what that means in a little bit, but if you consider that your one cloud spend is a whole big box that has different components in it, be it databases, storages, Kubernetes, whatever, it's probably a little bit unjust to just do one single bucket. So identifying smaller subset with unique identities, of course, will increase your accuracy. It also has a side benefit that the blast radius of wrong assumption is immediately limited. Assume you underestimate your transaction volume by 50%. That will only affect those buckets that you forecast using the transactions. And some of these buckets, some of these deviations might even offset each other. You might underestimate one, might overestimate another, and at the top level it combines to a net zero. It also helps to incorporate the expertise of all the local teams that have their own bucket into the forecasting process. Imagine one FinOps team looking at 100 buckets and trying to understand the structure, the technical components, the business need for them at a central level. It's impossible. But when you make those buckets owned by the decentral teams, you incorporate all their knowledge into the process. These local teams will know what's driving their cost, which demand driver to use, and how to model those costs going forward. So that not only makes the forecast itself better, it also makes it easier later on for the teams to track their budget and to establish responsibility across the entire organization, and then in turn strengthen your FinOps culture. However, there is a big trade-off with all of this. So in theory, all of this sounds amazing. Imagine you have a big piece of pie and you want to cut it in, I don't know, we cut it into 100 pieces. When you start cutting it, it's easy to determine the size of these pieces, but the pie doesn't stay the same size. Throughout the year, the pie changes, the complexity changes. Maybe you want to take pieces from part A and want to put it to part B. So maintaining all these buckets throughout the year is a huge challenge. Establishing these buckets is a huge challenge. And putting all of this data into your cloud transparency tooling is a huge work to start with. We work with our partners at Cloud Zero almost on a daily level in just maintaining the structure of 100 buckets. That's a lot of work. So make sure you consider those trade-offs before. How granular do you really want to get? So let's talk about how to get granular. How should you drill down into your AWS cost or into your cloud cost? I've provided a checklist that has worked well for us. And I would say if you can answer 2 or more of those questions with yes, it is time to get granular. So let's look at it. Is cloud cost a priority across your org chart? So do you think BUs are able to own and interpret their own cloud cost? If the answer is yes, it's probably good to start segregating across organizational lines, so across BUs, across squads, across cost centers. Second one, do you deliver heterogeneous products? Do you have a bank account? Do you have a credit card? Do you have a lending product? Do you have crypto? If the answer is yes, chances are those products also behave differently in terms of cost. So it might also be beneficial to segregate into these products as well. Does your cost fluctuate cyclically? Meaning, do some of your components have a seasonal spike? Black Friday is a classic. In Brazil, for example, our transaction volume constantly peaks at the end of November for Black Friday, whereas our lending transactions don't really move because it's not as seasonal. Do you have projects on the roadmap that you know are going to hit you in Q1, 2, 3, 4? Also a good idea to isolate those projects into a separate bucket and forecast the seasonality on a very local level. Do you have significant cost in multiple tech stacks? That can mean, do you have cost in database? Do you have cost in Kubernetes? Do you have cost in storage? All of these components behave differently. Kubernetes, for us, for example, behaves extremely correlative to customer transactions, whereas our storage cost does not. So of course, you also have to segregate those out. And then finally, do you have a small number of infrastructure components dominating costs? This could be, for example, that one microservice that dominates 90% of your spend. For example, maybe you isolate this and model the other 10% differently. So that gives you 5 dimensions, and usually the answer is a combination of all of them, and that again drives up complexity. So provision a good tooling that helps you provide visibility to all the BUs involved in the budget process is essential. Just to give you an idea, we use two separate environments of our cloud cost transparency tooling. One is where we show our current cost with our current scenario, current allocations, current org chart, current logics. And then we have a second tenant where we already implement the future budget allocations that we plan to implement on the next cycle, so that BUs can go to that second tenant and look at what their cost will look like under these new circumstances. Because our allocations will change, cost centers will change, cost structure will change. So providing these two tenants for us is essential in enabling BUs to look at what their cost would look like in a different scenario. And then for reporting purposes, also onboarding and maintaining these buckets, I've said it before, is the complexity increases with the amount of buckets that you have. So we have over 100 buckets now, and we talk to our cloud provider, a cloud cost transparency provider, almost daily to maintain these buckets. I said before, granularity was the first step that we did that helped us to get from terrible to medium level terrible. And a second element that we introduced is the demand driver. Demand drivers are a metric that I've said before that predicts cloud resource usage and is therefore a proxy for cloud cost. It represents the customer's use of a given product or service. And this, of course, does not only include external customers, such as transaction numbers, it can also include internal customers for horizontals, such as fraud transactions, etc. Why is this so cool? It connects the business expectation with cost. We use this chart on the right side to separate those two factors. We call that the demand driver variance and the unit cost variance. Every team when they do their forecast, needs to forecast their demand driver. So as their demand driver diverges from their forecast, this of course has an impact on their cost. Imagine you predict 1 million transactions per month, all of a sudden you have 2 million. That's great for the business, but it also means that your cloud cost will likely increase. Is that bad overall? Probably not. It even helps you to explain why you're above budget. The other component is your unit cost variance, and that's the deviation from the expected unit cost if you factor out all the demand driver impact. So this is really what we can relate to as efficient or inefficient, and especially that second part is usually within the control of engineering, either through scaling decisions or architecture decisions, whereas the demand driver variance, I mean, the engineer is unlikely to be able to have any impact on customer behavior on a larger level. So separating those two impacts is really important and encourages a sense of business value in engineering decisions. It also features the concept of unit economics. I've said before, unit cost variance is based on unit cost and the unit economic concept. So this chart is really powerful in explaining to leadership why you're above or below budget. You can easily say, okay, we've had more business volume, that's why we're above, or even the other way around, we've had less than expected business volume, but we're still above budget. So there must be some inefficiency in the process, and teams can't hide behind saying, we had more or less than expected volume on our infrastructure. So how do you start with demand drivers? Well, we started by providing all our central company KPIs to the business units as a starting point. That's usually customers and transactions for us as a bank. This might be different for your business, but it's usually a good starting point of providing something, because it will be new to the teams, and the teams will have no idea what a demand driver is, where to look for a demand driver, how it should be available, what should be the frequency, whatever floats your boat. It's important to provide, at least in the exploration phase, some starting point from a KPI pool. It will greatly facilitate the learning curve, and because teams already have an idea of where to start and what to test and how to get to a good demand driver. What do we understand as a good demand driver? Well, the obvious part is it should correlate with your cost, because otherwise it doesn't really affect your cost curve. We worked with a correlation coefficient of 0.5 when we started. I think probably 5 out of 45 BUs had this correlation coefficient, but it's a starting point, and it will take multiple cycles for BUs to get there and really understand which part of their cost to model with which demand driver. There should be a business fit with the cost and budget segment. The business should provide this demand driver for the upcoming cycle. This is important so that the ownership stays with the business. If the business forecasts transactions, this is the key component for your cost forecast and therefore maintains the ownership with the business itself. Operationally, those numbers should be available daily and in automated form. Daily, because to be statistically relevant, you probably need at least 30, a sample size of 30. And if you do monthly, probably you look far too back and can't do any more accurate regression testing. So it's important that these numbers are available daily and in automated form. And of course, available in transparency tooling. I brought the screenshot here on the right side. This is from a screenshot from Cloud Zero, our transparency provider. This is we currently maintain over 46 demand drivers. Again, that puts a lot of effort. That puts a lot of stress on analytics engineers and on the teams to implement those and also to maintain those and to connect the right demand drivers with the right buckets. Because as I've said before, one key is to get as granular as possible or as necessary. And then take those buckets and pair them with the right demand drivers. So you have 100 buckets, 46 demand drivers. They all need to be connected in the right way so that you have the correct unit cost and business to cost connections. Right. Finally, the forecasting of cost with a demand driver only will tell you already a pretty good story of where your cost is going to land. But there are going to be projects on your roadmap that take you away from demand drivers. For example, if your credit card team is going to implement a new feature in the upcoming cycle, this is probably not going to be reflected in your unit cost. So if you forecast a static unit cost with a good demand driver, but you have an increase throughout the cycle through a project, you need to separate those impacts out and add them on top of your demand driver-based projection. All right, so let's resume. Combining higher granularity and demand driver was what truly unlocked the full potential. When we've only used granularity, we were still pretty bad. When we only used demand drivers, we also were still pretty bad. But combining those 200 buckets, 46 demand drivers, I mean, probably you don't have to scale it up to these extremes, but combining those two is what truly unlocked the potential of reducing our cloud budget deviation from 75% to 1%. Each segment is forecasted with their own demand driver. And as I've said before, it takes several cycles and support across the organization. Every single bucket needs to be forecasted. Every single demand driver needs to be maintained. When you start, probably you won't have perfect correlation for a lot of the buckets, a lot of the demand drivers that you want to use. So it takes some patience, it takes some time. Eventually, you will understand which buckets behave in which way and need a certain demand driver. And now what should be next? I mean, we're at a pretty good budget performance this year. But one of the things that we see on our roadmap is to focus on usage over cost. Why? Because the cost is a product of usage and price. Price decisions are usually out of the hands of all the engineers. So giving the engineer a usage budget makes it probably more relevant for the engineers. So that's on our agenda. Then separate fixed and variable usage or cost. I mean, just from statistics, a fixed cost and a non-fixed demand driver has a correlation of 0. So isolating these components that are considered fixed cost from your variable cost will in turn make the forecast of your variable cost a lot more accurate. And then, of course, further improve correlation between demand drivers end cost. All right, that takes me to the end. I'm open for discussion after this presentation. Of course, we're very happy to be here. It was a pleasure to present not only this morning, but also here. And we hope that was interesting to you to learn about how we got from 75% deviation to 1% using granularity and demand drivers. Thank you.
So my question, has anyone successfully transitioned from single cloud cost center to a more granular breakdown, such as team or project level? And what were the biggest technical and organizational hurdles in making that shift when you did?
Yeah, we are single cloud only, so we unfortunately haven't made this transition. But we've made the transition of breaking down our budget from one budget into organizational level budgets, which are 45 of them, and then in those 45 budgets, drill down even further into sub-budgets. So this transition has worked incredibly well for us, but it takes several cycles. Most of you probably are doing the budget centrally still as a FinOps practice, as you go through run, crawl, walk, run in your FinOps journey. But yeah, providing as much as KPIs as possible, helping the teams to understand their cost composition and correlation to demand drivers is what really helped us to find demand drivers that actually have a good, that reflect costs good enough for us to have a good budget performance.
Thank you.
Hey, Thomas, thanks for the presentation. Our favorite honorary Brazilian. You talked a little bit about business units giving insights and demand drivers. You talked a bit about the analytics team who also plays a part in it. My question goes to how involved is finance in this exercise? When and where do you bring them into the discussion, if at all? And has this given any insights to finance regarding cloud budgeting?
Yeah, so good question. So this is a bottoms up exercise. So of course, everyone pitches in all the entire wish list, right? So if you ask your teams, hey, how do you think your unit cost is going to be? Most of the teams are going to say it's going to stay stable or go up. And then you end up with a budget that is pretty big. If you have a track record of budget performance as we did, chances are finance team is going to cut, an arbitrary number, a number that corresponds to what leadership envisions as an efficiency ratio for total cloud cost. So yeah, this is the first input that we provide to the finance team. We are elaborating this process as well because like we do this whole process and then finance team comes and throws around an arbitrary number, also kills the vibe, right? So then what we're doing now is we get a target efficiency ratio that we know already. We have a rough number in mind where we could end up in terms of cloud cost, and we go into negotiations with the business units. So we look at season year-over-year growth, for example. If there is one business unit that is increasing by an absurd amount, either they can explain it through whatever product or regulatory or architectural decision they're making, or finance is going to take away from them. But on the plus side, the decisions have become a lot better because now finance is arguing with the actual owners of the problem instead of with the FinOps team who's like saying, I don't know where these 80% are coming from. So the conversations have gotten a lot better. Of course, it drives up effort. You need finance people to look at 100 buckets and understand which of these 100 buckets are growing reasonably or not. But this is where the two worlds combine for us currently. So yeah, this is the input for finance.
Okay, here's my question. Thanks for awesome presentation here. As you mentioned here, that's a reduced budget deviation from 75% to less than 1. So that's awesome. But you mentioned that you have like 46 buckets or segments, and there might be deviation in some of the buckets or segments, so more than 1%. And when you have some of the business units or buckets have more deviation, what do you do? How do you follow up with that? So that is one part of the question. And then the other part is when you do the forecast for the entire year, do you follow up, like do you tweak your forecast on a monthly basis or quarterly basis, or like you see something is upcoming, something is not really aligning? How do you change the course? Two part of the
Yeah, so the first part of the question, I have to admit, this 1% we got pretty lucky this year. You know, I mean, crashes. One day of a Kubernetes crash already blows out our budget if you're operating on these margins. And as lucky as we got this year, probably as unlucky as we got in the other years. So these 75% to 1%, of course, covers not only the entire spectrum of our forecasting skills, but also the entire spectrum of luck. And then some of these buckets actually even out. You know, we've seen this a lot. The more you break down your buckets, the higher the chances are that one of those buckets is going crazy and another one is going crazy into the other direction. So they offset at the top level. So the further you break it down, the more you limit, what I said again, you limit the blast radius. Wrong assumptions do not reflect itself across your entire budget. Wrong assumptions stay limited to the bucket that they were used for. And the second part of the question, well, okay, sorry, can you repeat?
It's like forecasting. So how often do you look back to the forecast and readjust? How often you do that? Like, is it like monthly, quarterly? You tweak and adjust?
Yeah, good point. Our main KPIs that we use here are forecasted on a monthly basis. When you try to look at, that's an excellent question. When you try to look at correlation, monthly will not help you because the sample size is either too small or your period fluctuates too much because there are 30 months, you know, it's a long time. So when we try to establish correlation between a demand driver and the cost of a bucket, we look at daily cost. And we try to have all of these KPIs available on a daily basis. But when you forecast out, monthly is enough. We have our budget is annual in 12 cycles, so monthly.
Thank you.
Hello. Hi. I have a quick question. Which are some of the cadences that are in place? I know that, for example, finance is tracking each of the buckets individually, but as a FinOps team, which are some of the cadences that you guys have in place? It can be like weekly, monthly, or like every once in a quarter to track these buckets of work, because I mean, over 100 buckets just like a lot of work.
I mean, it sounds like a lot to track 100 buckets, but if you have them available in a dashboard, you can basically look there daily. You know, we report in monthly cycles, so we officially track them on a monthly basis. But if you see a bucket off track already on day 10 of the month, you know, it's time to intervene. And to be honest, after 1 month, you already know who your black sheep are, and you know exactly where to look at and where to reprioritize also, you know, because that's another benefit of this view. If you see, I mean, line 3, probably none of you can see it, I can because I'm closer, 272%. I mean, this bucket probably isn't going to be at 270% just in that month. It's probably already has some problems. So that's an opportunity for management also to reprioritize and allocate efficiency resources or engineering resources to that one bucket to drive down that number. It helps you to isolate your problems much better and increases visibility on where the problems are.
All right, great talk. Question, so how do you measure the correlation coefficient, whether something is actually helpful or not? Can you talk about the underlying technology, tools, models, data science aspect of it?
Yeah, so when we started, we used Google Sheets, to be honest. You know, you take the daily cost and you take the daily values for the demand driver that you choose, and it tells you your correlation coefficient over that time. Now we also have a dashboard where you can drill down into any cost bucket that you want, be it per BU, per squad, per product, per AWS service, and correlate it with our 45 demand drivers that we have onboarded in our transparency tooling. So you can do these correlation analyses at any time for any bucket on a daily basis. And teams do it. But again, it's just a starting point. It's likely that even though we have 45 demand drivers onboarded, there will be a number 46, there will be a number 47. It's just a natural progression of the curve eventually. eventually more of these buckets will emerge. I know 100 sounds like a large number, but it's all relative, you know, once your organization is accustomed to that. 2 years ago, everyone thought 43 buckets is a lot, and now we're at 100. Your demand driver, your correlation will increase, and your demand drivers will become much more relevant.
This is excellent. Thank you. And then once you've identified a good demand driver, how would you then translate that into cloud cost from a forecasting perspective?
Yeah, so you take the forecast of that demand driver, which is business owned, and you multiply it by what is your historic unit cost over what you think is a representative period of time, usually like whatever, last month to last 2 months. And this already, this multiplying this already gives you your cost.
Perfect. Thank you.
Pretty straightforward math.
Okay, we're gonna hop right here, but I'm gonna just hand the mic real quick. Here you go. Oh, right here.
So how do you manage the granularity and demand drivers for shared services across multiple BUs?
Sorry, I didn't get it.
If resources are shared by multiple BUs, how do you achieve your granularity and demand drivers?
Yeah, so resource allocation is a different topic. When we look at cost per whatever BU, for example, this already is based on allocations. For example, our biggest shared resource is Kubernetes. So we already allocate Kubernetes cost to the different BUs. And then after this allocation, we take their cost level and calculate the unit cost. So first we allocate, and then we forecast.
Can you talk about the demand driver forecast and maybe especially on the annual cycle of that, if there was any sensitivity from collecting that from the business of them kind of forecasting their, you know, volume for the following year?
Honestly, the biggest challenge in getting to these KPIs that we provided for the teams was to find the one source of truth. The issues of we don't want to publish this number, we didn't encounter on our journey. Honestly, biggest challenge was you know, there were probably 3 or 4 customer totals floating around. Which one is the one you trust? Same with transactions. Every BU sort of using their own little flavor. Active customers, inactive customers, customers that haven't used their card, you know, like it goes. There are a lot of different variations, and that makes it sometimes hard to know if the BU is using the right one. But other than that, in terms of restrictions of using demand drivers, I can't recall that we had this issue.
So I have 2 questions for you. The first question is that since you have 49 teams or so, 45 or 49 teams, how do you make sure that they are not inflating their budgets in order to stay, you know, within budget? And the second question is really difficult. Do you do Brazilian Jiu-Jitsu?
Sort of the first question, how do we make sure that the demand driver forecasts aren't inflated? Well, most of them are business metrics in the sense that they are not only used for AWS budget, so they're used in revenue forecasts, they're used in all kinds of forecasts. So this is how we implicitly make sure that those values are correct. I mean, on the few buckets where we have more technical forecasts, such as Kafka messages, to be honest, we haven't had this issue yet, that BUs use the tactic of inflation. What's more likely is to ask for higher unit cost, anticipating some projects that you want to squeeze into your budget. But the demand driver forecast itself so far hasn't shown any issues.
Hi, okay. So when you switched from your like FinOps run budget to your BU owner run budget, does FinOps still drive that conversation and like suggest and bring numbers to the table? Or is it fully on the BU owner to come up with that budget on their own? And the second part is, politically, how did you get buy-in from all the BUs to be participants in this process?
Sorry, what was the first question?
Does FinOps still run the budget?
Yeah.
Do you suggest the values and work with the BUs, or is it on them to?
Okay, so we cluster our BUs into different types of FinOps maturity, A, B, C, D, reflecting their financial participation on the total cloud cost and their maturity. So on the larger ones, the A and B ones, they are so mature already. It's cost is such a large consideration for us as a bank. Cost efficiency is such a large consideration as a bank that we consider those BUs mature enough. And actually, with the example of the BU that created 26 buckets, that came from them. Like when I looked at their table and I saw 27 tabs, I was like, really? Someone invented 27 tabs? So I was very happy to see that. So we don't have to make those suggestions anymore. We make them to new BUs or less mature BUs. And then the very small ones we don't even use demand drivers. They're too insignificant to go through that process. And the second part?
Politically, how did you get them to have buy-in into this process instead of FinOps owning it?
Politically, it was pretty easy. We showed them this and said, hey, look, what we're doing doesn't work. And we can continue to give you numbers that you need to justify yourself against, that you didn't make on your own. Good luck with that. Probably you don't even know half of the assumptions that we made. Or you calculate your own. You find your own demand drivers. You tell us, okay, I have 50% S3 cost, 50% Kubernetes cost. I want to model both of them differently. So, I mean, this discussion was pretty easy. The results speak for themselves. And I think also conceptually, I think it's a pretty easy sell to have people create their own budget. It's much easier to justify than if someone else does it for you.
Hey everyone, producer Andrew here. Thank you so much for watching and for your support. For more FinOps X 2025 content, go check out our YouTube channel. Like, subscribe, and leave comments and questions for all of our wonderful speakers. We appreciate your support.